well, which was making money back then. So the average PE of the tech sector of the S&P 500 was 90 then. The rest of the market was 20. The rest of the market really wasn't overvalued. Maybe slightly, but not significant. It was the tech sector, which was 90. What's the tech sector today? 20? 25, people are asking me about, well, are we back to 1929? No, definitely not back to 1929 or 1999 onto the market. We talk about PE ratios. We should talk about earnings. We're in the middle of earnings season right now, and everyone's talking about earnings, and everyone's talking about how great earnings are going to be this year with the tax cut and all the rest. Well, first of all, how do we define earnings? Well, there's a lot of different definitions of earnings. There's the most liberal definition of earnings, which is what our firms are giving out right now. So after the close, when you hear that Intel or Netflix or Apple, so to speak, beat the street, those are firm-reported earnings. They're the most liberal way of looking on earnings. They exclude asset impairment, severance costs, cash costs, closing costs, litigation expenses, etc. Some of them include option expenses. A few still don't include option expenses. Right now for the S&P 500, the estimate of 2017, and we're getting the fourth quarter now, is about $132. Estimate next year, wow, $155. We'll talk about increases here. Then there is what it's called S&P operating earnings. By the way, those firms are also called operating earnings. Now, what is the difference? Well, about 20 years ago, Standard & Poor's said, you know what? Not expensing options, not taking out all those costs is really silly. They are costs. And they redefined operating earnings in a more conservative way, which, by the way, I think is the right way. You can find this on the S&P website, all their estimates all the time, of what is the true value of the company. Warren Buffett also says that he uses S&P operating earnings when he does his valuation of the market. It excludes some asset impairments, except for the financial sector, and it doesn't exclude severance costs, but it includes option expense and pension value changes and all the rest. It is lower, of course, than firm-reported earnings. Estimate for this year is $124. Estimate next year is still high, but not as high as the firm report. And then you have GAAP earnings, generally accepted accounting principles, the most conservative, in my opinion. Way too conservative. Now, we could spend a whole session on that. I mean, you guys, many of you probably have many more accounting courses than I do. GAAP has changed, as you're going to see in the rest of this presentation, over the years. In 1990, the late 1990s, they made rulings that forced firms to write down asset values, whether they sold them or not. Of course, this became known under the rubric of mark-to-market accounting, which has gotten, as you know, a lot of flack back and forth. There are pros and cons, but it is so conservatively implemented. You have to write down if it's impaired, but generally you can't write it up until you sell it and prove that it's risen in value. So it's sort of a one-sided street. And a lot of firms, of course, look at their assets, and in a recession, they're not as worth as much. So they write them down. Can they write them back up? Not necessarily. We're going to look at this a little bit more later. This has a lot to do with what's going on in the CAPE ratio, the short CAPE ratio, which I'm sure many of you are interested in and want to hear about. 2016, it was 94.55. Estimate, notice, quite a bit lower. 2017, 110.02. 2016 was hurt because when the oil prices collapsed, all the oil firms had to write down all their reserves, which took about $10 or $15 off the GAAP. Estimate for this year is still estimate for next year is still very high. Well, I say next year. We're in 2018 now, so 139. Still, as you can see, much more. Anyways, summary, I like the middle one. More conservative than what you're going to hear on the street, but it's not anywhere near as conservative as the gap, and it gives a best idea. So when I'm going to be talking about PE ratios, price-earnings ratio, I'm going to be using S&P operating earnings. Okay. With that in mind, let's go. What do PE ratios mean for stock? Everyone here knows about dividend yields, or what it is, the dividend divided by the stock price. Not maybe as many of you have heard of what's called the earnings yield of a company or the market. It is completely analogous. Earnings divided by price. Dividend yield and earnings yield would be the same, of course, if firms paid out 100% of their profits as dividends. It turns out that the earnings yield, which is the reciprocal of the price-earnings ratio, is the best predictor of long-term real stock returns. Now, I could go through a proof of that, theoretically, but let me give you some pretty interesting information. Long-term PE ratios. I said in the post-war period, it's 17. If you go back to 1871, where we can go back to PE ratio, it's about 15. And a lot of people do quote that. They say, what's the average PE ratio of stock? 15. What is 1/15? 6.7%. Now, is that eerily close to a number that we talked about at the beginning of this talk? Yeah, most certainly. That is the long-run real return on stocks. You know, it amazes me. I don't teach finance. Actually, I teach macroeconomics. My PhD at MIT was in macro, but with a lot of financial material. But I look at a lot of finance books, and I'm always amazed because there's a section early on long-term return on assets, that I showed you from Ibbotson and elsewhere. Some of them use my data. And I always talk about, well, long-run return on stocks, 6.5% per year. And then 10 chapters later, they talk about PE ratios. Oh yeah, average PE over history is 15, 16, or whatever. They never make the connection. Yeah, the inverse of the PE ratio is going to be the long-run real return on stocks. That's the amount of cash, and it's a real asset. That's why it's a real return. Contrast to a bond. It's a nominal return. So keep that in mind when you use projections. All right. S&P 2810 on January 19th. Stocks are selling around 22 times last year's earnings. And I'm using S&P operating earnings. About 19.2 times this year's estimated operating earnings. Theoretically, it's supposed to be the next 12 months. But let me round it off. And let's say stocks are selling at 20 times earnings. Well, that makes it easy. Because 1/20 is 5%. So people ask me, Jeremy, what do you think next 3 to 5 years the real return on the stock market is going to be? And I say 5%. Yeah, it's less than the long run because we're higher at valuation. By the way, which we should be, as you'll see in the next little point in terms of the interest rate. If you add it a 2% inflation, Fed is close to that, Fed is trying to target that, that's a 7% nominal return, is my estimate, 3 to 5 years ends on the stock market. Of course, there's a huge standard deviation around there, as you all know, because of the short run volatility of the market. Now, what's the real return on bonds? The 10-year bond, the 10-year TIPS, is a 0.5%. So you get 5% on stocks at 20 PE. You get a 0.5% on TIPS. That makes the equity premium, what, 4.5%. The long-run equity premium is 3 to 3.5%. So we're not at all overvalued. By the way, just to go back to 2000, with a PE of 30, as I showed you, what does that project for rate of return? 3.33%. And guess what 10-year TIPS were? 4.4. And the inverted. Is that an overvalued market? Unbelievably, yes. Are we there today or anywhere near there today? Absolutely no. And by the way, some people try to tell me, oh, interest rates don't matter for stock market valuation. Really? Fixed income is the world's largest asset class. Everything is relative. All you finance students know. The fundamental theorem of finance is that the value of any asset, stock, bond, real estate, whatever, is the present discounted value of its future cash flows. And what is in the denominator of that present value? Interest rates. So don't tell me that interest rates don't count for what the valuation of the market is. Now, people say, well, Jeremy, we'll look at this. What happens if we go back to 4, 5, 6% interest? Well, we're not. We'll talk about why. And then you got another story. By the way, people ask me, where is that 5% return going? Well, let me tell you, there's about a 2% dividend on the S&P, maybe a little less right now. 2.5% net buyback of the shares, and the other 0.5% is spent on capital expenditures. That's how you're getting. So that last point is the tiny amount of the growth, buybacks, and the dividend yield is 4.5 of the 5%. That's where your 5%. There's something else one should really note, and I've actually written on this separately. You know, people say, yeah, going back to 1870, the PE is, the average PE is 15. I say, listen, what kind of return did you get from a 15 PE ratio back in 1870? Could you index how costly between 1870 and 1970 was to completely index your portfolio and make all the changes that were necessary? I'd say about 1.5% per year. Don't forget, there were no index funds, nothing like that. Bid-ask spreads were much higher. Brokerage commissions were much higher. 1.5% is not a lot. I was saying that, you know, on a risk-corrected basis, you were getting about 5% back then. Today, indexing is costless. 0. So think about that. You don't even need a change in interest rate to say that should generate a 20 PE. 5% rate of return is equivalent to a 15 PE when you have 1.5% transactions cost. Right? Another way to look at it. I mean, you know, people keep on telling me you should go back to the 15 PE ratio. I said, well, hey, tell me a little bit about why you think that's the case. If you go to your Bloomberg and get world price earnings ratios, you get this slide. Give you PEs based on last year's, this year's, next year's of the major markets in the world. But you see basically what they are. S&P on base last year was 23, 18.6 this year, 16.9 on 2019. By the way, take a look at Europe in the middle group. Much cheaper than the United States. Europe is about 20% cheaper on valuation than the United States. You take a look below, that's Asia. The Nikkei is biased a little high. The Topix is about 18. Hang Seng index in Hong Kong is 12.8. The Shanghai Composite is 13.5. S&P AX 20, now that's the Australian index, 16.2. Straits Times, Singapore, 14. These are very reasonable PE. In fact, I argue low PE ratios in a low interest rate world. But I do see better valuation opportunities outside the United States, just on the basis of valuation. Now, a lot of people say, Dr. Siegel, we know you're very good friends with Bob Shiller, which I am. We met on the first day in graduate school, September of 1967 at MIT, and we've been close friends since. Bob Shiller developed in the late 1990s a concept called the CAPE ratio. The CAPE ratio stands for cyclically adjusted PE. And what he says is, you know, we shouldn't use last year's earnings or next year's or this year's. Let's do the average of the last 10 years. Actually, that's what Graham and Dodd did when they were looking at what is the valuation on the market. They said, let's take the average of the last 10 years. So he said, I'm going to judge it by the average of the last 10 years. So his earnings is average of last real. He deflates it by the price earning, the CPI index, and takes the 10-year average PE ratio. In December of last year, it hit 33, nearly double the 140-year median value of the series. It's a very pessimistic projection of next 10 years. He thinks real rates of return, based on this index, are only about 1.5%, only about 1/4 of the long-run average. Here is the KPE ratio over the period. It starts in 1881 because you need those 10 years. Earnings start in 1871, so you need 10 years to develop the first one, up and down. You can see the peak in 1929. You can see the super peak in 2001. We're at 33, so we're just about at where we were in 29, still below where we were in 2001. But you know, I looked at this graph, and I said, you know, something's interesting. Since about 1980, we've almost always been above the average. It doesn't look balanced. And yet, returns have been good and valuations have been raising. What is really going on here? Well, first of all, a couple of facts about the CAPE ratio. In 426 of the 432 months from 1981 through 2017, actual 10-year real returns in stocks have exceeded what the CAPE forecast. By the way, I should have mentioned, when he did this work, he used the CAPE ratio, regressed it against 10-year real returns forward, and it produced an R-square of nearly 40%, which was astounding. You can almost never get R-squares of that magnitude when you're projecting the stock market. Now, it was 10-year projection. It was a fascinating and quite startling result. But as I mentioned right here, in the last 20, 30 years, it's underestimated the actual rates of return. There have only been 9 months since January 1991 where the CAPE ratio has been below its mean. When it's below its mean, you're bullish on stocks. Above the mean, you're bearish on stocks. The CAPE methodology called the U.S. stock market overvalued, and again, I mean it moved over the median, in May of 2009, when the Dow was 8,500. So if you were using the CAPE ratio as a guide to your investing, you would have started selling out of the market in May of 2009. Not a good choice. Dow is now 26,000. You would have sold out of the S&P at that point at 919. What fascinates me, how many people are slavish to this theory, despite how bad it's been. And by the way, I'm referring to the giants in the profession. You know, Cliff Asness, Robert Arnott, Jeremy Grantham of GMO. I mean, these people, and he just capitulated. He's saying, I don't understand this market, whatever, abandoning what I thought I knew. Steve Wright in the UK, who works with Andrew Smithers, you might remember the book Valuing Wall Street, the Q value, which also has gone way off. There's many reasons why that is there. But these people, also the Economist magazine, which I respect a tremendous amount, slavish to the CAPE. When they talk about markets, it's only the CAPE ratio. They don't use anything else, and they've been calling the market overvalued for 6 years. If you've been reading the Economist magazine, Financial Times, which that's great. John Author's a great author there in financial. He's actually one that's been looking in this. So Jeremy, we love it here. People love it here in UK, but you're right. It's been absolutely terrible as predicted. But let's look why it's been terrible as predicted. Here's the series of earnings that Bob Shiller uses. Now, from 1871 on, real per share earnings. Now, I looked at this and I said, this is interesting. You see, the last two. The last one is the financial crisis. The one before one is actually the mildest recession we ever had, which was in 2001. But earnings were going down an awful lot. What about the Great Depression? Everyone looks back at that and says, no, the Great Depression is not that big decline there. That was actually World War I, where it went way up and way down. That bar is the Great Depression of the 1930s. Now, I said something's funny. The Great Depression was orders of magnitude worse than what we had in 2009. And yet earnings declined a lot more. In fact, they declined as much in the mildest recession as in the Great Depression. Until I said, just a minute here, he uses GAAP. GAAP changed. Totally changed in the 1990s. Once they started mandating mark-to-market accounting, of course it's going to decline dramatically in every recession. Now, I'm not going to go into arguments whether that's right or wrong. I think it's wrong for ongoing projections. The problem is you cannot do economic analysis on a time series where for the first 3 quarters of it, it's calculated in one way, and for the last part of it, it's calculated in a totally different way. Now, by the way, that was not Bob's fault. When Bob did this work in 1997, that was when the changes were made. Now, I said, hey, let's use a consistent way of looking. That was the Great Depression. Let's look at a consistent way of looking at earnings. This is Bob's series. That's operating earnings, S&P, which doesn't include the markdowns. In other words, that operating earnings series is a consistent series before the change. Or let's use national income product accounts. You notice again, you don't have that big decline. Why is that big decline so important? Because he uses a 10-year simple average as earnings. And we're still in the 10-year window that includes the tanking of earnings because of the mandatory mark-to-market in 2007, 8, and 9. I redid Bob's take ratios using operating earnings and the nickel profits, and it is much less overvalued. I haven't updated that over the last couple of years. You know, certainly the reported, which is the GAAP earnings, have gone way up in comparison. But you don't get the overvalue. By the way, I read an article on that called The Short Tape Ratio, a New Look, published in the Financial Analyst Journal last year. So you can look that up. Actually, the Financial Analyst emailed me saying, Jeremy, this is one of our most downloaded articles that we have had. And by the way, I attest to the power of the tape ratio using a consistent series, but not using an inconsistent series that most people use because you just stop with the gap. Collapse of world interest rates, probably the most dramatic development that I didn't expect to more. Here's the 10-year tips. As I said, it was over 4% in 1997. It went below 0, now it's about 0.5% today. Let me first break the biggest myth that I hear from Wall Street. The low interest rates are caused by central banks. Totally false. I say, thank God the central banks have followed the interest rates down. The low interest rates that we are caused by fundamental forces that have changed over the last 15 years, such as, of course, very low inflation, slow economic growth, high private and regulatory demands for liquidity, increased risk aversion of aging investors. Investors get older, get more risk averse. And one of the most important things, negative beta on Treasury bonds. Now, what do I mean by that? Let me skip ahead and I'll go back to this slide. This was an article that was done by John Campbell, who was, by the way, the co-author with Schiller on the tape ratio, and several others. As you guys know, when you talk about returns, you need to know the beta of the asset. Well, there has been a dramatic change in the beta of Treasury bonds over the last 15 years. It's gone from very positive in the 70s and 80s to very negative now. It has become the hedge asset. And what are the returns on hedge assets? Very low. That is a major reason why the 10-year Treasury is still at 2.7 and 2.8. And by the way, another reason why the term structure is going to be much flatter in the future. By the way, people are all worried about the term structure inverting, and yes, that is true. The single most important indicator of a recession is an inversion of the term structure. But one should remember that from about 1950 all the way until inflation started, that's when the beta became very, very positive. The average spread between the 10-year bond and the 90-day bill was about 60 basis points. Then it went all the way up. Now it's coming down. The negative beta could even be less. People put bonds in their portfolio because it hedges against stock market risk. Bad event happens. The market goes down 800 points. Your treasuries are up. That's very comforting to people, even though they're getting terrible interest rates from that. Let me go back over here. Actually, it was 2014, Bill Gross. Following the work of Richard Clarita, who is a professor who worked for PIMCO when Bill Gross was working for PIMCO. You remember Bill? Bill Gross was the one, along with Mohammed El-Arian, when he worked for PIMCO, who coined the term the new normal. 2 years later, he coined the term the new neutral, which basically said not only are we going to have slower economic growth in GDP terms, but we're going to have much lower interest rates. Neutral is a term, by the way, it's used by the Federal Reserve to refer to that interest rate that's neither expansionary or contractionary. Bill Gross was actually the first one to declare that the new neutral was 2%. Zero real with a 2% inflation. That was a follow-up, by the way, Richard Clarita's work, and I was very disappointed because about 3 weeks ago, Richard Clarita was named as a possible vice chair. And I said, wow, we need someone. Because Jay Powell, although all his qualifications, as you know, is not an economist. And we need a powerful, someone with a lot of good economic background, I think, in the vice chair position. Obviously, Stan Fisher was that, but he had to resign because of medical reasons. But I heard he has now been ruled out. Again, I do not know the reason, but that would have been an absolutely a wonderful choice. By the way, when Bill Gross wrote this in 2014, I mean, that's 4 years ago, people laughed. The Fed was saying, oh, the neutral was 4%. Boy, have they come down. Look at this is the dots. The last one is the dot of the neutral Fed funds rate. It's now 2 3/4. They're not at 2, but they rose from 4 to 4.5. They kept on lowering. Started saying, you know, as time has gone on, I also agree that you're right. You know, with these low interest rates, where are you going to get income? And as you say, you know, Matt McCormick was saying about dividend stocks. Here's the S&P 500. Here's cash dividend income from the date that the S&P was founded in March of 1957. That's the blue line. And the pink line is the consumer price index. You want something in high and low inflation times that beats inflation and grows. It's that. And let me mention to you the entire decline of dividends that occurred in the financial crisis was due to the financial sector, which was mandated to cut the dividends. Some of them were cut because they didn't have the earnings, but a lot were cut there. We bounced back dramatically. Dividends growth has been such. All right, last slide. Outlook. We're going to have 3 to 4 hikes, I think, in the Fed funds rate to 2 and 2.25%. I think the long bond moves to 3 1/4, but it's not ever going back to the 6-7% range we had before. The yield curve was going to be flatter, but far from flat. I think, I was on CNBC a couple weeks ago, and I couldn't believe it. I think I was the most bearish person on set. I said 0 to 10% for the markets this year. I mean, I had 5, so we're already halfway through. But I think there's interest rate headwinds. I think there's political headwinds for the Republicans. I mean, I like the corporate tax cut. I think people are getting too excited about it. Don't forget, the corporate tax cut is front-loaded. What do I mean by that? Allowing expensing of capital instead of depreciation. It's good at the beginning and then not as good toward the end. Right? So a lot of people are looking and say, oh my God, earnings are up 23%, and not realizing, ooh, that's really going to tail off later on. You take a look at that. I'm not bearish again. I think we're going to have a correction sometime this year. I think there's too many momentum players. They're just riding a trend right now on the market. And it certainly looks like it's going higher before it's going lower. I see better opportunities outside the United States. I still think, don't rush and sell your stocks. But I'd be cautious on adding a lot to your positions. And here's my last graph. And thank you guys. Thank you very much for your attention.
Thank you, Professor Siegel.
It's on, yeah, it's on.
Thank you, Professor Siegel, for your 2018 economic outlook. We will now be taking questions from the audience. So if you have a question, please flag down a mic runner or submit it through the app. One of the questions that we've received through the app: how will the repatriation of the U.S. corporate assets affect non-U.S. companies?
Well, one thing, let me also say about the repatriation, I could have mentioned it back then. It gives a big hit to GAAP earnings, many of which are taken in the fourth quarter of last year. So you're going to see now a big, no pun intended, gap between GAAP earnings and operating earnings. So we're definitely going to see a back. I think this corporate tax reform is excellent. I think it's long overdue, and I think it gives us, a corporate tax system that's more consistent with the rest of the world. What it'll do, yes, I mean, it'll mean there'll be less, obviously, movement and less mergers and no inversions and all the rest, which I all think is very, very positive for the United States. I don't think particularly it's, some foreign firms fear it in terms of lower taxes. They will have to become a little bit more competitive, but I don't think it's going to hurt their earnings significantly. I think it's a question of finding the market pricing, correctly and enjoying and realizing the efficiencies in production.
And any questions on the floor?
Yeah, we do have a traveling mic. Yes, thank you.
A lot of your research talks about publicly traded assets where the prices are observable in a market with a willing buyer and willing seller. Have you given thought to how the trend line of stocks might apply to privately traded assets and the premium that you would build into that and what durability there might be over long periods of time? Just curious about your general thoughts.
Well, when people look at this, they say, Jeremy, this is really a fascinating graph here. Where's real estate? And let me tell you, we do have prices of real estate. We don't have returns. Now, we have REITs only the last, 20 years, 30 years. So we don't have long run. So we have long-term prices, but the return compounded is, in real estate, is that net cash return. Those who have tried to put it in, Ibbotson has put one in and others, it looks a lot like stocks with a return that's about 1% lower. But again, there's a standard error around that. Now obviously when you get to other like private equity and things like that, we really don't have any long-term on that. The real estate would really be the one I'd love to add to that, and I said if I'd add to that, I would think it would look pretty similar to stocks, and maybe just a little notch lower in terms of return.
Any other questions on the floor?
Just real quick, you know, you showed the CAPE index up there and how it's kind of been above the curve. Is there any relationship with the significant amount of debt that's been taken on to kind of keep the party going, or really since Reagan in the 80s and going forward, the significant amount of debt that's been taken on? Is there any relationship that has kind of shifted that? Is there any relationship there?
Are you referring to public debt or the corporate?
All the debt, that, you know, government debt, to personal debt, household debt, you know, everything seems to be.
Well, the interesting thing is, although the debt ratios are moving higher, the actual financing ratios are moving lower because of the low interest rates. So there is more debt, but it's easier to finance. Now people say, well, interest rates will rise, but if they don't rise much, the burden is really not different. We do know, of course, that the long-term debt of our government is unsustainable. And it's unsustainable because of mostly Medicare and partially Social Security, those commitments. If those become more long-term solvent, that solves the government debt ratio. Right now, I don't think government debt, I mean, Treasury, because of their negative beta, which I don't see disappearing soon, the demand for Treasury debt is like insatiable, almost, and not excessive. Corporate debt is higher, and it should be higher when you can finance at 2% or lower. Why not?